Good morning, everybody. Thank you for joining us today on Fundamentals with Matt Burk. I am your host, Matt Burk, and the show is all about running real estate asset-based funds, starting them up, running them, winding them down, and all things in between. And today we have Heather Dreves joining us from Secured Investment Group. Heather is the Director of Funding and a fund manager at Secured, coming to us from Coeur d'Alene, Idaho. Heather, welcome to the show.
Good morning. Thank you for having me.
Thank you for being here. I really appreciate it. So we like to spend some time talking about kind of how people got involved in running their own private real estate asset-based funds, and we'll get into that a little bit, Heather. But I'd love to kind of start with learning a little bit about you, where you came from, and kind of how did you get into the real estate business, raising money from high net worth investors. Give us a little background on you and your story.
Yeah, absolutely. Well, my story is kind of interesting. I actually thought I wanted to be a elementary education teacher. So went to college for that, and by chance ended up, deciding to stay home with our children until they were in school, and had a friend that was in the private lending space and knew nothing about it, and decided after our youngest child got into school full time that I was going to go to work for a private lender, and my eyes were opened. I had no idea that not only was there opportunity for people to get funding for real estate transactions outside of your traditional bank resources, but was even more fascinated by the fact that people could start to create wealth outside of your traditional stock market financial advisor advice. And so that was really kind of my path to this, and fast forward the clock 18 years later, and I'm now managing 3 real estate funds. My husband and I are active real estate investors. And so although I didn't go down that educational path, I also feel like I am an educator in some ways, because my passion is to educate people that if you have the right deal, there's funding out there, and there's other alternative asset classes out there to deploy capital and create wealth for yourself. So I guess it was by chance. The stars aligned, and I'm just really excited to be here, and continuing to work with clients that I've worked with for many years, and now their families and friends. So
yeah, it's always amazing to me how, I've been doing it for so long now that you kind of forget, right? Because you're so buried into the space, but there's so many people that really weren't or aren't familiar with, how private money real estate loans work, and the fact that they exist, and that you can earn money doing it, or that you can borrow from private people. And so it is pretty fascinating. So when you first got into it, Heather, how did you get started in the private money space? Did you come on were you doing originations, or were you involved in processing, underwriting, or how did you learn the business?
I originally first started in originations, and then very quickly migrated over to more of the underwriting, the due diligence end of things, in addition to servicing loans. So these private loans that we were creating, we were also servicing everything. So after about 2 years, they were looking for someone to get their securities license, because at that time we didn't have funds. We sold fractional interest in notes or liens.
Yeah, I was going to ask, were you funding them one deal at a time? It sounds like you're fractionalizing them. So for the benefit of some listeners, what does fractionalizing a trust deed mean?
So fractionalizing a trust deed is where you have multiple investors that purchase percentages of that actual note. So for example, if it's a $100,000 note and one individual purchases 50,000 of it, he's a 50% owner in that deed or that lien. And we would have up to 10 investors on a note. And at that time in the state of Washington, it did require a securities license. So I held my Series 63 for many years while doing that.
Yeah, I was going to say, and I know that in fractionalizing trust deeds, a lot of that's state by state specific, right? But it can and does require securities licenses, so your Series 63 or 7, right, in order to be able to go and solicit and raise money from investors for that type of a vehicle, correct?
That's correct. Yeah, that is correct. And like you said, it is state specific. So anybody listening, I would suggest get with your state and find out what their guidelines are. There's going to be state, but then there's also federal laws too. So.
Yeah, so you were doing fractionalizing trust deeds one at a time, which
Mhm.
is an effective way to do it, but it's also can be very cumbersome if you're doing significant volume. So how did you gravitate? Because this is the kind of progression that all of our clients eventually make, is going from doing them one deal at a time with either a single investor or fractionalizing them to doing it in a pooled fund. How did you
Right.
tell us about that transition?
Well, like you said, it's cumbersome when you're doing, one deal to one investor or one deal to multiple investors. It's clunky. You've got a lot of my clients work with self-directed IRAs and those kinds of qualified funds. And you've got on one end of the transaction, you've got a broker and a borrower that are anxious to close, and you're dealing with a contract that may expire. And then on the other side of it, your passive investors that are purchasing or funding the deal are basically funding it at the table, right? So you're trying to coordinate funds coming in. So 10 years ago, we decided that there had to be a better model. And quite honestly, some people don't want to buy a note. There are some pros and cons to that, right? You can typically get higher yields funding a note or a lien, but it comes with some risk, right? Your borrower might not make payments. I'm going to be calling you saying, hey, Matt, this person's not paying. We need to foreclose. You need to front foreclosure costs. So it was a natural progression to a fund model, right? Where we could close quickly for our brokers and borrowers. So essentially, we can raise capital into this real estate fund that we're managing. We can accommodate our investors that are a little bit less risk adverse. They're like, hey, I like real estate. I like the asset class of notes, but I'd rather be more diversified. I'd rather take my $100,000, put it in a fund environment, and my capital is spread out over hundreds of assets, versus putting it into one deal and having to run the risk of dealing with this person not paying. So it was a pretty easy decision to make, and it from a fund management perspective, it's just an easier model to manage, right? Providing it meets our guidelines, fits the box of the fund, we can close quick, accommodate our brokers and borrowers, and then on the other side of the transaction, we can sell the paper, we can hold it in our asset portfolio if we want to. We can still accommodate people that want to buy notes because we can sell those assets out of there. So it accomplishes a lot of different things rather than just one transaction.
Yeah, I have found that people have a lot of misconceptions coming into running a fund, and they have ideas about what it's going to be like, and some of them are accurate, some of them are not. But what did you learn through that process, or maybe tell us what were some of the more difficult situations or things that you didn't anticipate that you had to contend with once you started running a fund?
Yeah, I mean, gosh, I don't even. It's hard to know where to start because it's been this 10-year evolution of this fund, right? And process.
How big is your fund now? Just to give people some context.
We have two funds currently, and collectively we have about $45 million in them.
And these are mortgage pool funds, correct? They're loan real estate secured loans are the assets that are in the fund.
The majority of the assets in the fund is real estate debt. So it's 75% of the portfolio of the funds. We like to sprinkle a little bit of real estate in there. So we do hold 25% of the balance in real estate assets in our local market. But I think the biggest part of the funds that's gotten bigger, I think we've started noticing growing pains over the last few years. When you're dealing with a couple hundred fund members, it's fairly easy to manage, right? Once you get past that and you have, like right now between the two funds, we have probably 900 different members. I think at that point you have to start investing some capital in systems and software, to manage it, because trying to do it through spreadsheets and things of that nature is just not efficient and effective. We have an online platform that we run our investors through that make investments. That's the way they have access to their accounts. A lot of these investors in our fund model like to reinvest their earnings, so they're creating a compounding growth model, but they want to log in and see and watch their account as it grows. It's not realistic for them to be calling me every day wanting an account balance. So I think at some point as a fund manager and operator, you have to make decisions and investments in systems like that, right? Where people have this online access. They can make additional investments if they want, things of that nature. Some of the challenges are reporting. We're really transparent with our members, but it takes a lot of team members putting this information and data together on a quarterly basis, so that we can give that to the investors. So it's really things like that. I think, the back end of it is a lot of the challenges with managing a fund.
Yeah, I think if people underestimate the reporting time suck that it puts on the team members to put that information together
Right.
on a quarterly basis. How about capital raising? How have you guys gone about tackling the was that, because that's a huge part of
It is.
running a fund
You know,
successfully is raising money.
A lot of it's referrals. I think that's kind of where you start when you go down this path, is friends and family. And if this person's having a good experience and getting great returns, they're going to tell somebody else, and it kind of snowballs. Recently, we've started spending marketing dollars. We are part of a lot of different types of networking groups. I mean, VeraVest has been a great asset to us and gotten us exposure being on your guys' platform. Getting in with some of these IRA custodians, being on webinars like this, podcasts. I mean, I think, and I tell my team this, people invest with us, yes, because we have a good product, but they also invest with us because of who we are and our track record and our history. And so I think that's something that is probably discounted by operators. Like I got to spend all this money marketing, and which is great, but tell your story. Tell your story, be open about your history, whether they're wins or losses. So we're doing a lot of different marketing things right now, but I think really just getting your face out there and people knowing who you are and that you're going to answer the phone if there's challenges, that's a big part of the marketing component too.
Yeah, and it's changed a lot in the last 10 years, right? With social media, the rise of social media, and a lot of the different things going on out there. It's changed dramatically. What are you guys seeing in the market right now? Is the demand for real estate loans, is it good, better? Are interest rates helping you or hurting you, or what's going on in the market?
Our demand has increased over the last 6 months. Our fund is not leveraged. And I think what I've seen over the last 6 months is fund operators that were relying on Wall Street money are starting to go by the wayside. We are a direct lender. We originate and deploy what we raise, and that's just our model. So we're still around, which says a lot for us. And I think because of that, and because of some of these other private lenders going out of business, it has created more activity for us. But we're still looking at them and being very, very cautious, right? Just because you have a lot of deals coming to you looking for funding, you still have to weed through a lot of garbage. We don't want our performance to be affected just because everybody's hyped up about the activity. So our business has increased. What I have seen as a shift with private lending with our borrowers specifically is most of them were fixing and flipping 12 months ago. Even 6 months ago, it was still pretty advantageous. We have seen a lot of them wanting to hold those properties as rentals.
Yeah.
That has definitely changed. We now have a 30-year rental product, so we can still provide the bridge financing to buy the property, rehab it. Now they have an exit where they can actually refinance into a 30-year rental product. That's been the biggest change I've noticed.
And then you mentioned something there, Heather, that you said you guys didn't use, or you don't use leverage. Is that a deliberate choice, or like why? I mean, I know a lot of private lenders and real estate mortgage pool funds will use leverage. Why haven't you done that, and how has that helped or hurt you?
Well, I think we're unique in the sense that our debt that we originate, we also sell. So we don't just hold all the debt. So if we were holding all that paper and not selling it out of the fund and recouping our capital, the leverage component would make sense. The other thing is the real estate that we hold has always been short-term in nature. We were selling them within 60, 90 days of buying them. We have started to look at possibly leveraging some of the real estate assets that we're holding. But we don't have a line of credit that sweeps off all of our debt, and then we can go out and re-originate more. And it just, the numbers haven't made sense, and we haven't needed it because we have so many people that buy notes from us. That's really kind of what we have instead of leveraging. Our fund is open to leverage, and it might make sense down the road, but we have not had the need to.
Do you even use warehouse lines? I mean, do you have any lines at all in there, and none at all? Huh?
No, we'll originate 30 notes in a month, and we'll sell 28 to 30 of them in a month. I mean, they turn that quick.
So on the selling of the notes, so is the model in the fund then you're originating, and then the intent is to turn around and sell them? How does the fund make money then if it's not earning the interest? Or are you putting the points through to the fund, or how does that work?
So the fund does earn a percentage of the origination points, but when we sell that paper, we retain an interest strip. So
Okay.
if we write it at 10, we target to get a 2 to 3% interest strip. And that's where the fund continues to make profit and interest revenue off of those assets.
And in exchange for that, you're servicing the paper on behalf of the individual note holders as well?
That is correct.
But the fund's getting that interest strip,
Yes.
as opposed to the opco.
Mm-hmm.
Yeah.
Yeah.
And do you still originate? I mean, do you always originate in the fund, or do you originate? I mean, a lot of people I've seen where if you have more deal volume than you do capital, then you may end up just originating loans directly with your private investors, or are they always going through the fund?
90% of what we do is through the fund. Like I mentioned, we now have a 30-year rental product, and we have a couple other things like ground up construction products that we don't run through the fund. And we are in talks with some other, for lack of better terms, warehouse lines of credits for some different products. And so I would say right now, currently, 90% of what we originate goes through the fund. But there's always other opportunities, for things that are outside of the box, outside of our credit box of our fund to continue to originate.
What does your team look like? Like how big of a team does it take to do what you guys are doing, just to give people a sense of what it takes to run a fund successfully?
So currently on the fund management side of things, and this is going to include our loan originators, processors, underwriters, we have in-house counsel, we have a huge accounting team, we have an acquisition team, we have about 50 employees currently.
Yeah, well, that's a pretty good size.
Yeah, well, but that's going to include property management. We have a property management division. We have a servicing team. I have a team, investor relations under me. So yeah, we haven't always been that big. Like I said, it's been, this organic growth for quite a while. But you have to have those processes in place. It's difficult.
Yeah, no, I mean, you've got 900 investors, like is that just in the fund, or is because then outside the fund, you have a bunch of investors on top of that, right?
That would be just inside of our funds, that number, and then we have all of our people that buy notes from us, and that's probably another 100 active note purchasers at this time.
Yeah, well, that's a lot of responsibility, right? You're fiduciary for a lot of people's money, and it's money that matters very, very, very deeply to these people. So what else you got on the horizon? Any new funds? Anything exciting coming up? What you got looking forward to?
So we're looking at opening another fund. One of the things that I've, and I think you have to be in touch with your client base, right? Like, what are they wanting? What are they needing? And that changes on a daily, right? Given this environment that we're in, there's a lot of fear out there to invest, just in full transparency, and all operators are experiencing this. One of the things that we've heard a lot of is our funds have what's called a 12-month tie-up period. And in relation into the funds syndication world, that's a very short period of time, right? Syndications are for 3 to 5 years usually. But what I have heard a lot of from investors is, I want access to my capital if I need it. And it's not, most of them don't pull it out anyways. They just want to know that if they had an urgent situation or they felt this wasn't the right investment, that they could get it quicker than 12 months. So we're looking at opening an additional fund with a 90-day call. And it's going to have just a flat 6% return on it. And it's going to be, for those clients that are nervous about tying it up for 12 months, or maybe someone just needs to park some cash. I get that a lot. I don't know about you guys, but we talk to people all the time, and they're like, hey, I just sold, my building that my dental practice was in, and I need to park some capital till I have to pay taxes next year. This is what this fund would also help accommodate.
My understanding is there's some limitations on what you can do from a security standpoint in terms of the time frame on which people can get demand capital back. Is that how do you structure that with the 90 days, or what's your understanding of that?
So our securities attorney is looking into all of that right now. Our thing is that they have to stay in for 90 days, and then at that point they could ask for their money out. And then he is going over that. So I don't have the details on that because I also
Yeah.
heard the same thing. They're looking into all of that for us. So to be continued. I'll update you when I find out.
Yeah. That's what I've also found in managing funds, right? Is there's all kinds of rules that you have to contend with that you don't necessarily, anticipate or understand fully, heading in. And then,
Right.
I've certainly, speaking for myself, I've had to learn the hard way on
Well,
a bunch of,
we have
on a bunch.
we have a Regulation A+ fund. So that is, for everybody listening, that's a fund that unaccredited investors can invest in. And I will
Yeah.
tell you, there are far more rules and regulations with that fund than our 506c fund.
Yeah. Because Reg A is almost like a publicly traded company requirements of reporting and so on and so forth. So,
Yeah.
everything has its trade-offs.
Yes.
So Heather, it's like I always like to ask people as we get toward the bottom of the hour here, what is any book, audio book, or learning thing that you find valuable that keeps you sharp in everything you're doing?
Yeah.
You share with us?
Yeah, well, currently I'm reading a book which actually was a recommendation from a colleague of both yours and I, Mike Slotnick. It's called The Uncertainty Solution by John M. Jennings. And it's really just about how to invest with confidence in, currently the market that we're in with all the unknowns and everybody's fearful. It was a really good book. I enjoyed it. I thought it was timely, just given the headwinds in the marketplace right now. We are, and I mentioned this, at the top of the show, we're dealing with a lot of investors that are just nervous right now, not because of anything we've done, but just considering the market, the economy. There's other operators out there that aren't performing. So I actually assigned it to my team to read. We assign a book every month, and we pay them $100 to read it and write a book report. So there was just a lot of nuggets about, basically shutting off the noise, right? As an investor, shutting off the noise, and it's good to be up to date on the news and everything, but there's just, like you said, social media, podcasts, these investors get on all these platforms and they don't know what to think. And so that's a good tool right now. I really enjoyed it. My team enjoyed it. I think it's helped them understand when they're talking to our clients where some of this fear is coming from. So I would highly suggest it. Mike suggested it when I saw him at an event about a month ago, and I would recommend it.
Yeah, cool. Well, I've picked up several good recommendations by doing this show, so
Yeah.
I'll definitely look into that one. Heather, how do people reach out to you if they want to get a hold of you? What's the best way to reach you?
They can always reach me directly at my direct number. It's going to be 208-451-7836. Or they can go to our website. If they go to our website at Secured Investment Corp, so no plurals on any of those, they can always get information about our funds. They can contact me. They can schedule an appointment with me. We've even got a free book offer if they search securedinvestmentcorp.com/book offer. It's a very short book I wrote on just alternative assets, just a very educational book. But if for some reason they want a hard copy, give me a call again at my number. That's 208-451-7836, and I'll get them all hooked up with that.
Okay. Heather, thank you very much for being on the show.
Yeah, it was a pleasure. I appreciate you guys having me on, and we've always enjoyed our interaction with VeriVest. You guys are, making a statement in this alternative asset class, and we appreciate, the content you guys are putting out there. So thanks for having me.
Thanks for being here. We appreciate it. Thanks everybody else for joining us. Come back and join us again next week. Same time, same place. Look forward to having you. In the meantime, stay sharp.